Thank
All
you,
right.
everybody, for joining today for Zoe's workshop. So first, I'm going to provide a very brief disclosure. This presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. Our mission here at Zoe is to accelerate our clients' wealth through exceptional client experience and innovative technology. So we get the question a lot, how exactly does Zoe help? And the way that we do that is by rejecting 95% of advisors so you don't have to. Today's workshop will feature two of those 5%. They are absolutely fantastic advisors, and they're going to be sharing how you can protect your wealth through a number of end-of-year financial strategies. To get started, I'll begin by introducing Andres Garcia-Amaya, Zoe's CEO and founder. Prior to Zoe Financial, Andres was an executive director at JP Morgan Asset Management. While there, he oversaw over $300 billion in assets. He is a CFA charter holder and obtained an MBA from the Wharton School at the University of Pennsylvania. There, he received both the Joseph Wharton Fellowship for Outstanding Record of Academic Achievement and the Togo Foundation Fellowship. With you, Andres.
Great. Thank you so much, Alexandra, and for the whole marketing team here at Zoe for putting together this great webinar. So now I get the pleasure to introduce the real stars of the show. So I'll start with Melissa. Melissa Gerckens is a CFP and an advisor at Beacon Point. Let me remove this out of the way here so I could look at my notes. So Mel partners with Beacon Point's investment and financial planning teams to deliver the firm's clients and personalized wealth management experience. We've had the pleasure to have her in the network and already have seen tremendous positive feedback from the clients that have found her through the Zoe network. Previously, Mel worked as a financial planning associate, so she's a planner through and through in the sense of her background. And she has over 10 years of experience in the industry, specializing specifically in family planning. So thanks so much for joining us, Mel.
No, thanks for having me.
In addition to Mel, we also have Marcus Magyar joining us. He's also a CFP, and he's a vice president at CapTrust Financial. He's a financial advisor with 10 years of experience, and he concentrates on advising senior corporate executives, high net worth individuals, and successful entrepreneurs. He's devoted to helping corporate executives and business owners grow and preserve their wealth. And similar to Mel, the reason that we chose Marcus and Mel for this webinar is that they have terrific feedback from the clients that have found them through the network, and they're really truly experts when it comes to the topic that we're going to cover today. So thank you so much, Marcus, for joining us.
Excited to be here. Thank you so much for the opportunity.
All right. So what are we going to discuss today? I'm going to kick off the meeting by just kind of spending a slide or two on 2022 when it comes to what we have experienced as investors. And then we're going to get to the meat of the presentation, which is looking at tax planning, retirement planning, estate planning, keeping an eye towards the end of the year and how to prepare for next year, for 2023. And then we always leave time for Q&A. So if you have questions throughout, feel free to put it in the text there, and we'll kind of create a queue, or you could just wait till the end and ask your questions then. So let's get started with a quick glance at 2022. I don't know. There really nothing has happened, right? I think that Marcus, we were just talking about this, pretty boring year, right? Not at all, right? We've had a very volatile market. We have inflation that we haven't seen in the sense of like how much it has risen since the 1970s, right? Inflation at 8.3% year over year. We've had the worst bond market, worst year to date that we have seen in over 30 years. And there is data that points that we might face a recession in the coming quarters. Obviously, nothing's a given, but the data is not looking necessarily hot. And a big reason for it is because the Federal Reserve is rising interest rates, trying to beat down that high inflation number, right? So a really every year the market brings you something new, but I do feel like this year has been exceptional in the sense of how many kind of different things have changed from what we've seen in prior years, right? So a lot of times, obviously, the questions come in based on kind of that anxiety of what's happening in the markets. But we try to have these webinars focus on things that are more under our control, right? What can you do? How can you turn some of what's happening into a potential opportunity for yourself? The last slide that I have here that I just wanted to mention from an investment perspective that I think leads into some of the topics that we'll cover is that almost every asset class was down this first half of 2022, even in the third quarter of this year. Except for commodities. Bonds were down here in the US and abroad. S&P 500 was down. Emerging markets stocks were down. And obviously, that's not a chart you want to look at, but it does create potential opportunities, for instance, as we'll cover later, when it comes to tax planning, right? And even state planning. So yes, the world looks like it's upside down, but we should focus on things that we do have control, and we have the people to help us find out what are some of actionable things that you could do as you prepare for the end of the year. So with that, let's move on to a topic that is more actionable, right? When it comes to tax planning. And I'll just kind of go very high level to some of the things that we're going to cover. And then I'll let Marcus and Mel cover them more specifically. We're going to talk about how to manage your tax bracket buckets, how to think about strategies such as tax loss harvesting, especially considering what the markets have done, and charitable giving. And then last but not least, to take a moment to consider whether the standard deduction or itemization makes the most sense. So with that, I'll turn it over to Marcus to start with this. Next slide here. We have a couple buckets here, so maybe I'll just let you take it away. You're going to do a much better job kind of setting the stage on this next slide here.
Andreas, thank you. Once again, excited to be here, everyone. Well, Andreas, thank you for all the bad news. So hopefully Mel and I can change it up here a bit and focus on some positive items. And also, as you alluded to, things that you can control. Really, November's around the corner. As I look out my window here in the office, the leaves are changing for sure up here in northeastern Pennsylvania. There are things that you can focus on and have control over going into the end of the year, and kind of creating some tailwinds in 2023. Again, to pick on Andreas, with all the negative news around the markets, inflation, things cost more, most portfolios are down. There are things that you can add alpha being a positive to your overall financial plan, as we have these next two months to work on. And before we do that, most importantly is, and goes without saying, as we go through a lot of different topics, Melissa and I, is having a financial plan, which allows you to address all these different areas that we're going to be talking about. And I love bringing this up into prospective client situations where a lot of our clients, business owners, executives, professionals, have spent so much time building a business plan, a marketing plan, but a lot of us have built a big vacation plan as we look back on the year, right? And we spend hours and hours on planning vacation. But then when I ask that new prospective client, have you looked at your tax return? Have you looked at what you did in your 401k plan? Have you spent time on your own plan? And the answer is usually like, no, Marcus, I have not. So that starts there. And then to bring us is, as we talk about year-end financial planning is, let's start looking at your taxes. So as you look at the negativity of the markets, one positive is there are things that you can control. And the analogy we use here is to try and make taxes sound exciting is let's talk about some buckets, right? So first and foremost, before you do this, and this is another thing we find with prospective clients, and probably a lot of you, if we did a poll and asked you, is do you know what you make, right? I have found a lot of our clients when we sit down, as we're sitting in the office today, Mr. and Mrs. Client, what's your income for the year? What is your salary, right? It's like deer in the headlights when I ask that question, and most executives, even CFOs or entrepreneurs, have no idea, right? We just see the high paychecks coming in and we're spending, not realizing what that income is. So I think the first step is grab your W-2s. You can, if you have like an ADP type provider, see what you've made year to date, right? You and your spouse, you'll have a pay stub, you got 2 months left. We can do some basic math to see what your earnings will be. Also encourage you, go out to your 401k provider, your Fidelity's, Vanguards of the world. What have you deferred into your employer programs, which Melissa and I will talk about. Grab your 1099s of your investment accounts, right? What do you have from last year? And you can grab a year-to-date statement on your investment accounts. What are your gains year-to-date? Melissa and I are going to talk about tax loss harvesting and what are your gains or losses? What are your dividends year-to-date? So get an idea of what your income is at this point in time. And, for our executive friends on the phone, did you have a 10b5-1? Did you exercise options? Find out where you're sitting today income-wise. Then we can start to look at the buckets, right? And if you look here, single and married filing jointly, where that kind of puts you as accelerating income, which I'll talk about. And on the far right, looking at deferring income, for those that make more than 215 as single or more than 431 as marrying filing jointly. So what does all this mean? So the first thing to think about is in these first buckets here is possibly accelerating income. Well, you might say, well, Marcus, that sounds crazy. Why do I want to accelerate income and pay more in taxes? It's painful enough. So depending on your financial situation, you may want to realize and accelerate capital gains this year versus next year. Why? Well, maybe your income's expected to go up next year, through your employer if you're an entrepreneur. Maybe you're expecting big bonus payouts next year. Maybe your spouse is going back to work. You might have more income next year and want to accelerate those earnings this year before maybe you're going to jump up into the 35% tax bracket next year when maybe you're in, the 15 or 20% tax bracket this year. Also, capital gains, maybe your income is higher this year. There are break evens in the capital gains rate where maybe you're paying 15% in capital gains. But if your income goes up next year, maybe that jumps up to the 20% capital gains rate if your income is usually north of $400,000 or $500,000. You want to think about that. Also, as we're about to talk about tax loss harvesting shortly, you might want to realize some of those gains this year to get rid of some of your bad investments, kind of clean it up a little bit, and then maybe look at some better opportunities in the marketplace, especially with the market pullback, though up recently, still up significantly from the beginning of the year. And we see this all the time. We had clients in the office today who came to us originally with concentrated positions. And it's common for the big technology companies, the Apples, the Amazons, the Metas, huge concentrated positions, and usually significant capital gains, even with where the markets are at today. Let's put a plan together and that let's realize a little bit of gains along the way, because on the negative side of this, same client, we meet them 20 years from now, they've never touched that position, and eventually you have to pay the man, if you will. So being able to spread those capital gains along the way will make things a lot less painful later on. The second item here on accelerating income is hot topic, right? It's on, Andreas was talking about being on CNBC. It's always on CNBC, Bloomberg, pick a news outlet. There was a big article over the summer in the Wall Street Journal about doing Roth conversions. At the highest level, what does that mean? It's taking your traditional, your pre-tax, converting it into a Roth IRA to grow then tax-free at that point. I'll pause here and say, a lot of mistakes we've seen clients make in coming to us initially is that because their neighbor's doing it or their colleague, right, they think they should do it as well. That is very an individualized decision based on income and other variables. We've seen a lot of folks make mistakes there because it was the cool thing to do and may not be necessarily for you. The reason you would do this in an environment like this and for consideration, I call them here at Cap Trust, we use a term called nuggets. So some nuggets I would leave you is maybe you expect to be in a higher tax bracket both later and in retirement. We're going to talk about estate planning today. A lot of folks will have these retirement accounts growing and growing and growing with the Secure Act and a lot of these recent changes. You have to take this money out of your retirement accounts at an accelerated rate, causing a big tax bill to your beneficiaries. May not be a concern now, but definitely for your children who might inherit this or others, you can create a tax-free inheritance for your loved ones. Tax diversification. I pound on the table all day about this with clients where I'll meet a client who's 60 and this whole time has just been putting more and more and more money into things like just a regular 401k plan. On the back end of this, they hit the big number, right? They have 5 million in all their retirement accounts. They then go to take it out. It's all being taxed at ordinary income. It might look good on the surface. On a $5 million portfolio, the first required minimum distribution, Melissa and I will talk about today, Right now it's 3.7%. That's $185,000 of ordinary income, putting you at the very least in the 24% tax bracket. It's not necessarily a good story on the back end of all this. Also, income might be lower this year than other years, right? Maybe your spouse wasn't working this year, but is expected to go back next work. The biggest thing is asset values are down. So you could take an asset that's worth a little bit less this year, convert it into a Roth, less of a burden tax-wise now, and let it grow tax-free. There could be a lot of value in that by being proactive on this as we go forward. And the last bullet here, accelerating income, is redirecting savings from tax-deferred accounts to other accounts. This is another kind of touch point with a lot of our clients who come to us in newer situations, is that all of their savings, again, I mentioned this before, are just in a retirement account. We know all the rules. You can't touch that usually while working, except for exceptions. Think about putting money into, like a brokerage account or taxable account that you can access while working. Maybe that's something for your next home, your down payment on your first house. Maybe it's your deposit for your startup as an entrepreneur. There is some value there. Jumping to the right, we'll come to the middle, thinking about some things closer, but deferring income, you can see the income values here where this is important. Harvesting losses this year, right? Markets have been down. A lot of us have not been able to harvest any losses because most things have been up the last 5 years, especially as we came out of the pandemic. Take some of these losses. We'll talk about how that can create deductions for you as we go forward. The second one is one that we see a lot in prospective situations where capital distributions. I'm sure a lot of you actually last year looked at your investment account statements and your 1099s, were like, whoa, where did all these capital gains come from? You might be invested in mutual funds, for example, that pay obviously the growth we all want, right? In years like now, they also go down, dividends, but also they pay distributions to you. Now, it might feel good to get that 10% capital distribution from that fund. You add all that up, now you got an unnecessary tax bill. There are ways to avoid that. We call this proxy investing, where you can sell that investment, avoid that huge tax problem, go buy that asset class as a proxy, and still enjoy the fruitful gains from that investment. Charitable gifting, typically for this bracket, it makes a lot of sense to defer income. Melissa will talk about this in particular, of doing charitable gifting through things like a donor advised fund. A lot of you might be saying, what is that? Never heard of it. I think you'll find some value in that conversation this afternoon. And then lastly here, this is a big one. This impacts most of us, including myself and Andreas and Melissa, is maximizing your savings. For most of us, we're in the driver's seat to bring down and defer income is by maximizing your 401ks or 403b, depending on where you work, IRAs, we'll talk about this, health savings accounts, and other tax deferred programs I'll talk about later, our deferred compensation program. Melissa will share some insights into things like FSAs. Those are opportunities. And that's why I started this conversation with first, what did you make so far? And have you even maximized all these programs where you can defer a significant portion of your income?
Hey, Marcus, one of the questions that already came up that I think is good that we clarify here is when you talk about income, for instance, single 89,000, that's essentially gross, right? Like before any deductions or any, putting money towards your 401k, et cetera.
Yep. Yes, that is gross. And as Melissa will talk about, whether you itemize or not, that will help reduce that gross income. You'll hear the terms I'll say today, above the line and below the line, to bring down that net income, to help save you some dollars going to Uncle Sam.
Perfect. And I think the other, as you were going through this, the next slide, I think is going a little bit more detail in tax loss harvesting, because I know that is one of the things that, frankly, it's one of the few, call it like free lunches that exists as an investor. But when the market was always going up, it was one of those topics that people would say, yeah, like they would kind of roll their eyes and say like, yeah, great idea, Andres, but like all my stocks are up. So I can't really do this. And now we have the actual opportunity to do it. So we'd love for you to just kind of go in a little bit more detail, explaining how it works.
Right. So, as Andreas alluded to, you have an opportunity now, if you open up your statement, that you can take your capital gains you see in the illustration here, we'll call it investment A, good investment, And then investment B, apparently Andreas was investing in, since you all the negativity on the markets, it has a capital loss this year. And essentially, to keep this simple, is being able to net out your gains and losses so that, as you can see towards the bottom of this diagram here, you have some tax savings as you see some of the values being shown here, is the simplest way to think about that. Where you can get really creative here is, as Andreas mentioned, you've been investing for all these years, the markets have been good to us. There's things where you can do what's called lot management, where if you own Apple, for example, and you've been buying it all these years, you can go back to prior lots or share values you purchased that are maybe down, but your recent ones are up. There's ways that you can net these to create, to collect that value and have some deductions on your tax return. And as you see here noted, you can carry some of that forward to reduce future gains. So capitalize on some losses today to lower your capital gains to offset them. In this investment, A and B, one was up, one was down for simplicity purposes, and you can carry those losses forward. They'll limit it in future years where, as we joked about, you may not have any opportunity, but you can take that today, it has portability, and carry that forward. And a lot of questions here, Andreas, we have gotten, I'm sure Melissa as well, is be very careful. You want to do this, it's value here, but there's a thing called a wash sale rule, where if you go ahead and pick on Apple, you go sell Apple, for a gain loss and buy that thing right back, some of that could be non-deductible. There's certain windows you have to be careful for in doing that, but certainly an opportunity, a big takeaway is to take advantage of this and be able to also maybe look for better opportunities. Melissa, what are you seeing? Any other thoughts here on tax loss harvesting?
Yes, you really covered it, but from the Apple example, a lot of our clients work tax loss harvesting by, and we avoid the wash sale rule because you sell your investment A, or I'll call it C, and then you purchase investment D, which is very similar. So your portfolio is going to remain diversified, but you're going to avoid the wash sale rule.
Right.
Yeah, I think that's a great point. And I think one of the areas that we see a lot of people leaving kind of low-hanging fruit is because it's one of those where when you're doing it yourself, you might say, okay, yeah, no, this makes total sense, I'll do it. But then you don't do it, right? Like it takes some extra work to kind of go through this and do it. And there's some people that geek out over this and some people that will say, you know what, like Marcus, why don't you do it? Melissa, why don't you do it for me? Right.
And the big thing here too is, like, if you think about behavioral finance, is some folks have, we buy an investment that we're just so attached to almost emotionally, and it's just got nothing but beat up, but you just emotionally can't part ways with it. This is an opportunity where it's been tough. Maybe the fundamentals don't look good. Let's get something valuable out of it and be able to write this loss off and then go find, that next best thing in the marketplace from an investment standpoint. This is a little bit of that nudge to, to let it go, if you will, going forward.
Perfect. All right. So switching gears from tax loss harvesting, the next topic is on charitable giving. And Melissa, I'll let you take it away, but this is definitely another area from a tax planning perspective that a lot of times people miss the opportunity.
Great. Thank you. So we're going to go through two different opportunities here. The first one being a donor advised fund. So I'm not sure how much everyone's heard of these types of accounts, but it essentially, it's an account that we open up for each particular client. So it's their ownership, and it allows you, the donor, to make a contribution of highly appreciated securities directly to the donor advised fund. From there, you can gift out those funds over the course of however many years you'd like to various charities. Couple benefits here. One, you're getting an upfront deduction because of the contribution. Two, why did I say appreciated securities? So we encourage you to donate the most appreciated securities we can, because in a normal world, if you sold that investment to then use the cash, for example, to gift or do what have you, you're going to have to pay capital gains on any appreciation. When you donate the funds that are appreciated to the donor advised fund, you completely avoid that. So there's different benefits here. One thing to note, going back to itemizing your tax return, if you want to take advantage of a donor donor advised fund, you're going to need to itemize that year that you make the contribution. And a lot of us are taking the standard deduction. What we do for our clients, we review the portfolio, we pick out the funds that we want to contribute to the donor advised fund. We know how much that our clients are gifting every year. So we'll do a lump sum gift of 5, 10 years, maybe even 15 years worth of gifts. Do it all 1 year. You get the deduction up front, and then take, the next 5, 10, 15 years to gift it out over time. So we have our cake and we eat it too. We're gifting. We already got the deduction, and then we can just keep taking the standard. So qualified charitable distribution, this is a little different. It's for our older clients, those that are already taking required minimum distributions, so RMDs. And as Marcus mentioned before, any distribution from your IRA is going to be taxable as ordinary income. Now, we work really hard over the course of our life to build up large nest eggs. The only downside is the larger the IRA, the larger the RMD. And we want to make sure that we're being careful about how high our income is going. We may not be working later in life, but higher income means higher Medicare premiums, for example. So what we do here, the qualified charitable distribution, is when you take a portion of that RMD, up to $100,000 of it, and you donate it directly to a charity. So you're not utilizing a donor advised fund. You're not moving it to your taxable account and then to the charity. You have to donate it directly to the charity. And that entire amount that you just donated, there's no ordinary income tax. So it's going to help lower the income tax for the year, which will help with the other deductions and credits that get affected by the higher income. And unlike a donor advised fund, a little extra benefit is you don't need to itemize to do this. But again, it's for our older clients, our parents and grandparents right now that are taking RMDs. This is a great opportunity for them.
For those people that are not familiar with RMDs, is essentially what the government forces you to withdraw, right? Like required.
Yep. So required minimum distribution, the government saying, all right, we gave you tax deferral all these years. It's time to pay up.
Yeah. And even if you don't want to take that money, they're like, you got to take it.
Yeah, you have to, no matter what.
Yep. Got it. Okay. So that's on the shareable giving. And I see some questions coming in, but we'll make sure to move along so that we get through some of the retirement planning, and we'll come back to it. But this is definitely an area that a lot of people are not familiar. And I think there's a lot of good nuggets that Melissa just shared with. So let's move on to the retirement planning side. Because a lot of times people think retirement planning and they just basically think, oh, got it. So put money into a 401k, but they don't quite understand all of their employer benefits. So Marcus, why don't you walk us through some of those employer benefits that people often miss?
Thanks, Andreas. So yeah, this is a great opportunity, especially now. A lot of you, especially if employed for a corporation, maybe a college, university, it's typically open enrollment season in the employer world. So it's a good time just to check in your overall benefits. As we talked about earlier, as I mentioned, talking about our lovely buckets, is that it goes back to understanding, number one, what you're making, what you're earning at work. And then part of that point was, what do you have of your ability to use that's provided through your employer? There's some other opportunities as well. If you're self-employed, you're a consultant, you're an entrepreneur. But from an employer perspective, there are significant opportunities here allowing you to reduce your taxable income, maximize your contributions. And also, there might be benefits from the work that cost you nothing as part of your benefit program that you might be simply leaving on the table. The one right in the middle to jump to first is the 401k contribution. So for a lot of us who are employed by a corporation, or if you're college, university, of a 403b, this is a huge way to reduce your taxable income, where you can contribute with the new allowable amount, $20,500 in 2022, and then the catch up another $6,500 if you are over the age of 50. Congrats. This is an opportunity to max out. But here's a question for you. Did you know that you can contribute up to $61,000 in your 401k plan, potentially based on your plan rules? Did you know that? So a lot of our clients who come to us are not aware of what their 401k even offers. And there's the term we use called sources in the business of that. You have your pre-tax, your regular contributions, your Roth. There's a contribution allowed in 401k plans called after tax. That's for a whole nother time. And you can do what's called a Roth conversion, like we talked about earlier, which we were talking mainly about IRAs, for example. Your employer might allow you to convert those big balances pre-tax into Roth 401ks at work. So it is oftentimes we'll sit down with clients this time of year and, we're all inertia, we're terrible with it, but may enrolled in a plan and have always just been doing 5% and didn't realize you were able to do another 10%. And maybe you were missing out on employer matching contributions or profit sharing by leaving money on the table in that 401k. So I would remind you, especially this time of year, log into your 401k custodian. You can grab a, year to date, what have you done? And you're allowed to get up to that 20,500. But there's this gap between the 61,000 number and the 20,500 that you might be able to contribute up to based on your plan rules, being aware of that you always want to receive company match and profit sharing. So there could be some limitations there that you want to be aware of early. Also, quick comment here is maybe you maxed this out early. Question to go ask HR is, do you have a true up? I won't bore you guys this afternoon what that means, but a true up essentially, and the short of it is you get a catch up from the company because you maxed out early. You want to make sure you're not missing out on that. Deferred compensation plans. This is one of those, I'll say, compliments to your employer. Most Fortune 500 companies do offer these. You typically have to be eligible. We'll talk about in a little bit. It's usually deemed by either title, hierarchy in the company from a vertical perspective, usually defined by compensation. These plans are great because you could defer significant dollars above your 401k contributions, where in most plan environments, you could defer up to 95% of your compensation, salary, and bonus into these types of programs. But it comes with a caveat. There are some risks here. Depending on your company, these programs sometimes are unfunded. They have to be under a boring rule called 409A we have to follow, but allows you to take these big incomes, as we talked about earlier, if you're in that defer income bracket, really bring down your taxable income. And these plans typically mirror your 401k, where you can go ahead and invest in the market just like your 401k plan, but does come with significant tax savings, but just being aware of, that they're usually unfunded. Other quick comment.
Yeah, meaning on unfunded in the sense that if the company goes under, yes, they don't need to actually pay that compensation, right?
Correct. Yeah, and there's some questions you would want to ask. Is there corporate-owned life insurance? I know this is in the weeds, but there are questions that you can ask that make these plans a little bit more secure.
Yeah. No, and would you say that you often see people use this maybe as they're getting closer to retirement, so it's not like 20 years out where they'll get that company? Yeah.
Yeah, great question. There's also a good point that Andreas too. Thank you for reminding me. Is that I'm always very hesitant for my young executives and young entrepreneurs to take advantage of these, because the other rule with these programs, unlike a 401k, if you leave employers, that's a distributable event that has to pay out to you. So here you are, a successful professional making $200,000 a year. You had a balance in this. It has to pay out to you. You can't avoid that. Unlike a 401k, you can keep it or roll it over. To your point, Andreas, is typically later in career, you're going to kind of stay here. And that's also where you're in your highest income earning years. Because the biggest rule of thumb is, we and Melissa as financial planners, is that max out your 401k first. This would be supplemental to that. Okay.
Yeah. Let's touch on the FSA. I know that we have some cool slides from Mel on underfunded or overfunded. So let's move on to the FSA. Oh, did I lose you? You still there?
So, all right, Marcus, do you want me to tackle the FSA? Yeah, okay, great.
Yeah,
so you have the HSA and you have an FSA. So they're very different. It depends on the type of medical plan that you elect. So an HSA is generally for those of you that have a high deductible health plan. You get eligibility to contribute a certain amount per year to an HSA plan. And it's similar to like an IRA or an independent, brokerage account. It's your money no matter what. So you can use it now, you can use it tomorrow, you can use it in 10 years from now. There's no stipulation on when.
Like if you don't spend it, it doesn't go away type thing.
Exactly. There's no use it or lose it feature. And it's for qualified medical expenses. And, some of our clients are actually starting to build up a medical bucket, a medical savings bucket by funding an HSA plan every year, but they don't have a lot of medical, expenses right now. So they just let it build up. And then in retirement, when a lot of us have higher medical bills, you have a nice savings bucket there ready to pay for those bills. The FSA, that's a little different. So for those of you who have a PPO plan, so we call them like a copay medical plan where, you have a low deductible, you're paying maybe $25 per doctor visit. You're usually eligible for an FSA plan. So that's a flexible spending account. The one thing about these accounts, they're great. You're still putting in money and then you're using non-tax money to pay for your medical expenses. However, you have to evaluate how much you're going to actually use each year, because at the end of the year, it's a use it or lose it type of bucket. A lot of employers will offer one of two deferrals where you can roll over maybe $500 worth to the next year, or you have an extra quarter in the next year to use it. But yet, when we're working with clients, we have to be very careful that we're helping them to evaluate what their expenses are. If you're, again, going into a little bit of family planning, if you have your wife is pregnant, you're expecting a child, that you're probably going to use all the funds in an FSA account that they allow you to. So go ahead and fund it. But if you don't have a lot of medical expenses or you don't anticipate them, you want to evaluate first.
That's great. And I know that there's let's talk, actually, I'm going to skip this one and go straight to this, because we talked a lot of essentially like making sure you fund the things that you didn't even know you had, but there is maybe cases where you overdo it as well as underdo it. So we'd love to hear your comments on this, Melissa.
So I had a client recently, it's this year, and she changed jobs mid-year. So we wanted to really evaluate, it's closer to year end. What did she contribute to her last 401k? If she did want to maximize, so we wanted to be able to calculate what she should put into her new 401k, but we also wanted to make sure we didn't overfund it, because when you change, specifically when you're changing employers, there's that risk that you just put in a little too much or a lot too much, because it's two different plans. They don't coordinate with one another. For a lot of us that just have one plan, we're sticking with the same employer throughout the year. Usually there's some type of cap where they'll cut you off. But again, when you're changing employers, you have to be very careful of that. Also, she had always contributed to a Roth IRA on her own. If you're eligible for a 401k to contribute to one, whether you contribute or not, there are certain income phase outs that make you eligible or not to contribute to your own separate account. So a Roth IRA or traditional IRA. And in her case, she had every year done the max into her 401k and maxed out her Roth IRA. But again, year end, we have to evaluate how much did you make at your previous employer? What are you now making? What bonus expectations do you have? And unfortunately for her, we found that her income was in excess of what was allowed. But it was great that we reviewed it, because otherwise we would have just processed it like any other year, and then you're going to get penalized for that.
That's a great example. When you were saying about overfunded, you were talking about essentially like, let's say you left your company, you went to another company, but you're still contributing to the old one. Is that kind of like what you're saying? And both companies don't talk to each other, so you might be over.
So not that you would continue to contribute to the old one. So for example, maybe you contributed $10,000 from January to the point at which you left that employer. And you go to the new employer and you contribute 15 accidentally. They don't talk to each other.
Right.
So you've just now overfunded by almost $5,000.
Got it. That makes a lot of sense. And it's one of those things that you don't think about. It's like these companies don't talk to each other, right? Like exactly. They're not the same employer. Okay. Well, that's a great point. And I think that a good segue here to talk about estate planning. We cover a little bit when we were talking about donor funds, but let's talk a little bit more about estate planning. There's a number of different kind of ways to think about estate planning, especially heading into the next year. So we put this big $16,000 here. Why don't you explain, Melissa, what this is all about?
So the IRS allows each of us to gift a certain amount of money per year per person without it being considered a taxable gift. And a taxable gift is anything, so for 2022, anything above $16,000, again, per person, is going to be considered a taxable gift, which means you have to then file a gift tax return. And there's no taxes that you're going to be paying on that now, but there is a lifetime exemption of how much you can gift before you do get penalized and taxed. So we always encourage our clients every year, if you're single, $16,000 per person. If you're married filing jointly, you can do twice that. And again, that's per person. You can gift as many people as you want, as long as you just don't go above that number. And it's really just going to help you reduce your estate at the end of the day, because a lot of us are going to have taxable estates at the end of the day, and we want to be able to reduce that as much as possible.
Yeah, that's great. And this next slide here, I think is an important one. And Marcus, you could cover it, because we could sit here and discuss all the great things you could do in estate planning, but a lot of people just don't have a estate plan, right, Marcus?
Yeah, and what's kind of hits home, and this morning we had clients actually sitting in this other room here, and was just on that, just a complete estate planning meeting. And I would argue this number is higher, in that 67% don't have an estate plan. If we add to that, I bet you 90% don't have one, and the ones that do, it's probably wrong.
Right.
For example, we often meet clients, like today came in this morning and we had a estate planning meeting over coffee, and that their documents didn't speak to their financial assets. Would have been a big headache if something did happen, unfortunately. My favorite story is when a client has executors on their trust, for example, and it's their brother. They haven't spoken to their brother in 10 years. That would be a nightmare if something happened.
Right.
Or almost always happens, and could be a lot of you here today who are like, yeah, Marcus is right, is that have estate documents in place, but haven't been updated for 10 years, right? Federal and state law has definitely changed, and your families have probably expanded and evolved as well, could make some of those documents. And my favorite example from our clients that came in this morning when we reviewed their documents, there was two things. It's number one, the husband and spouse beneficiaries were different. So that was part of our review process. It was like kind of a fun argument in the office today. So look at your beneficiaries. Great table talk tonight with your spouse or your partner, that you want to make sure that they are correct. The other one was their will wasn't actually signed. So that would have been a fun probate case law that would be fought over, that you would want to avoid as well. So this is a big gap, I'm sure, in a lot of your personal plans. We always focus on the numbers, and this is the hardest thing to talk about, but there certainly is some estate planning steps as we go into year end and make it an action item preparing you for 2023 for sure.
Yeah, no, to your point there on having that conversation, step one, if you haven't set up a estate plan, is to do an inventory and evaluate those assets. You share that story. I'll share a personal one, which is, I worked at a big bank, Morgan Stanley, for years when I was right out of school. And the first time that I did a estate planning was in my 30s, right? So at 23, I wasn't married. I didn't have kids when I put in the beneficiary for that 401k. So when we were doing estate planning with my wife and our advisor, he was like, and it says here, beneficiary, your mother, right? And my wife's like, oh, and I was like, oh, I set that up when I was 23 years old, right? So to your point, like not evaluating who you have as beneficiaries, you're just delaying the conversation eventually, and it's going to get only more awkward as you get older. So, so step one is kind of do inventory of that. And, step two talks about account for your family's needs. Those change throughout time. On step three, either Melissa or Marcus, when we talk about establish your derivatives, what's another way of basically saying that?
Go ahead, Marcus. You can go for it.
Yeah, so it's really like we talked about your family needs, but what's really important for you, whether it's, legacy and gifting, you think about grandchildren, so on and so forth, keeping assets in the family, you can use that derivative terms very particular to your family situation that you want to have achieved, whether it's keeping money in the family, protecting things against divorce. It's really what's important for you, given your family dynamics, to use the rules of estate law and I like to call them strategies versus to be able to maximize ensuring those dollars passed on to the next generations, loved ones, maybe you're a business owner, it passes cleanly on to your partner in the business. It's really about what's important in that, passing money on or protecting, et cetera. Then that allows you then to start working on steps, 4, 5, and 6 to start to implement that.
I'll give just a quick example. It's not a very positive example, but it's important to think about. So when it comes to your will, how you're leaving the assets to your family, how you're leaving it to your children. If there's a situation where your child, I'll just use this as an example. This came up with a client recently. They were married, but the spouse was helping to assist his mother. And my clients really, were worried. Well, when we pass away and the money goes to my daughter, and then her husband is just going to use it to fund everything for the mother. We don't want that. So, that was a good conversation start where we said, let's talk with an attorney. Let's discuss what types of strategies we can use on how to actually pass that money to your daughter to protect it from, that type of scenario.
Yeah, no, that's a great example. And the next couple of steps here, we kind of covered to a certain extent, review beneficiaries, know your state's state tax laws, plan to reassess, right? It's not a one, set it and forget it. Like you need to kind of check in if there's any big changes or if there's, time has passed, 10 years has passed, like has the law changed, has your situation changed, et cetera. And then this last one, I think could be a good segue to the last part here of the presentation before we do Q&A, which is, you probably, I'll speak on the personal side. This is one area that even if you're not like super interested on the investment side, where you're like, look, I've done well for myself, the estate planning is an area where you do need to value the help of a professional because unless you're a state lawyer, right, there's a lot of questions that people might not even know to kind of unearth those questions. So it leads me to this, how to choose a Zoe advisor question here that comes up. I'm sure I already saw it twice come in the Q&A, which is like, great. Like, how could I reach out and connect with either Mel, Marcus, or other advisors in the network? It's a number of different ways, right? So you could call 646-680-9244. You could go to our website, zoefin.com, enter a couple of questions about yourself so that we can match you with the right advisor, or you could email us, concierge@zoefin. But this segues here to this slide here, because one of the things that we pride ourselves at Zoe is that we really go through a pretty rigorous due diligence process to make sure that we really have the best advisors in the network. But best is not just when it comes to their knowledge or their process, but they're really service oriented, and that they're doing this because they really love it, right? That this is something that they wake up every day and they want to do. Personally, when I started Zoe, I hated when you would, hire a doctor or something and they would just kind of be miserable, and you could tell that they hated their job, and you're like, I don't want to be here anyways, right? So having that kind of bedside manner and someone that really loves what they do is something that we also look. It's like that intangible that we look for the advisors in our network. So one of the things that we do in the webinars is just to ask, Mel and Marcus here, what are the reasons that they became a financial advisor? What kind of drives them to wake up in the morning? So we'll start here with Melissa first.
So it may seem a little cliche, but I really do enjoy helping people. And, finance can be complex. It can be overwhelming, and sometimes people just push off putting together their plan. And whether, it's related to their portfolio or the comprehensive financial planning services, estate planning, tax planning. People push it off because it's overwhelming. So honestly, for me, there's not a better way for me to add value than, to help align someone's life and wealth. And we do that through all the planning. And again, back to, I really enjoy family planning. And the reason for that is the first big stage where comprehensive financial planning comes into play. And as the first stage, a lot of people don't know where to go, who to turn to. So it's a great starting point for the relationship.
That's great. No, thanks so much, Melissa, for sharing that. What about you, Marcus?
Exactly what Melissa said. I mean, from my perspective, I get excited to get up every morning, to be a steward for my clients. And I truly, truly get value when new clients come to us and current clients with challenges and problems and needs, and being able to be with them and create a strategy, execute on that strategy, and being with them to help them cross that finish line, whether it's retirement, buying that second home, selling their business, and now being set for life. Truly, truly get value of that. I still remember a client, sitting down with them, wanted to buy that big beach house. And there's just no way this is going to happen. We did that plan. And I still remember getting that phone call. I think I was more excited that they did it than they were. Truly, truly, getting value out of that, and being able to sit down over that bottle of wine celebrating is really a win for me, and is really why I get up every morning. And my 94-year-old Hungarian grandmother, once said to me one time, she's like, Marcus, why would you ever want to do what you do? I've seen that movie Wolf on Wall Street. I'm like, Grandma, it is nothing like that whatsoever. We are actually the complete opposite, which is actually a story of why Zoe exists and the business model there. It's not like that at all. And I want to help people versus being a veterinarian or a doctor. I want to do this through, financial planning, investment management, et cetera, is what gets me fired up every day, and grateful to be a part of, the 5% at Zoe.
Yeah, that's a great answer. And last thing on that before we go to Q&A, just to explain what he means on the kind of the Zoe model, is that we don't have advisors that work at banks or that get compensated outside from you for the advice. And, the way I look at it is I don't believe there's necessarily evil people and good people as advisors. There's just incentives, right? And if you're incentivized to sell a product that's going to, allow you to bring your family to Hawaii every year, you know what? After maybe year 10, you're like, it'd be nice to take a trip to the family to Hawaii, right? It's that's when you're selling products. None of the advisors in our network sell products. And as a result of that, guess what? They end up focusing on providing great advice, because if they don't, then they don't generate a fee, right? So that's something that we, from the very beginning of Zoe, focus as well, is just making sure that we had practices, RIAs and investors that are independent and basically don't get paid from anywhere else outside of providing great advice. All right, so there's a bunch of questions that we're asking around, hey, how can we hire them? We covered a little bit of how you could go through Zoe, but the short answer of this is, when it comes to Marcus and Mel, the reason that Zoe exists is also to make sure that we're matching, in essence, your specific needs, your profession, your level of income, your assets, your stage, to ensure that the advisor we're putting in front of you is one that could kind of be ideal for your specific situation. But obviously, the reason that we bring Melissa and Marcus into the webinars, because as you can tell, they know what they're doing, and obviously that then attracts a lot more people to say, you know what, I want to hire one of them. So definitely make sure to check us out at zoefin.com. That's probably the easiest route, is just through the site. The last question that I have here that I want to answer is that we will have a recording of this that we'll email to you if you register through the webinar. So feel free to share as well. If you have other family members, friends that you say, oh, you know what, this was helpful. You don't have to ask us, just share it with them. Part of our mission is just to make sure that you know what's going on, and then you could accelerate your wealth through knowledge, right? So that's why we do these webinars as well. So with that, we'll end it there. I want to thank Marcus and Melissa for giving us their time and their valuable counsel here. And thank you all for joining us. Hope you have a great rest of your day.
Thanks, everyone.
Take
Thank
care.
you.